So I suggest we get started. It's a bit of an unusual time for us, ladies and gentlemen. A very good afternoon. Very good afternoon, Frankfurt. Good afternoon to our guests from 10 countries that registered today, and welcome to our 31st financial, actually breakfast, but today it's a dessert event in cooperation with the Association of Foreign Banks in Germany. After 1 month of pause, Food for Thought is back again, and we start our series of world-class speakers with great insights with a quite controversial topic, short selling and its merits. Who hasn't watched the movie The Big Short, talking about the group of investors that bet against the US mortgage market? The nerve-wracking and nail-biting stress of those going against the market, exposing themselves to squeezes and sleazes. The shorts on Wirecard had also had to be no less brave and long pressing. Bros tend to regard shorts as a necessary, even healthy part of the financial landscape, helping to discover correct prices and lifting the smoke and screen on some wobbly or outright criminal accounting. But short sellers are very often also accused to manipulate markets, hyping up dubious cases just to make sure that they win. Today, we are very honored to have Mr. Larry Tabb, the head of market structure research of Bloomberg Intelligence, with us. Larry joined Bloomberg in 2020, and prior to joining Bloomberg, Larry was a research chairman of the Tabb Group. And he's published widely, and I confess to be one of his avid readers. Dear audience, please feel free to input your questions during or after the speech in the Q&A section soon. I will bring them in front of Larry. Both the PowerPoint slides and the recording video of the presentation and the Q&A session will be posted on the Frankfurt Main website from tomorrow on. Larry, we're set. The stage is yours.
Thanks very much, and I want to thank Frankfurt Main Finance for giving me this platform to talk about short selling. I'm going to share my screen. Let's make sure that this works right. I think that works. Okay. I am Larry Tabb. I am head of market structure research for Bloomberg Intelligence. I'll talk about that for in a couple of seconds. I'm going to talk about short selling, benefit or bane, look at it in terms of GameStop and some of the crazy retail trading that was going on in the US. While my focus is going to be a little bit more in the US market, a lot of the issues and themes run across all products around the globe. That said, my focus on US markets will probably focus a little bit more on the regulatory reporting structure in the US. So to talk a little bit about that. So before I get going, a little bit about Bloomberg Intelligence. We are the independent research arm of Bloomberg, Bloomberg LP. There are 350 analysts, research professionals at Bloomberg. All our research gets put on the terminal. We have 500 data contributors. We cover 135 analysts, 2,000 companies. We do models. We put a lot of data on the terminal. We cover a lot of different equity sectors and markets and different issues around the industry. We're very much like many of the very large brokers, analyst sides of the business. Me, head of market structure research for Bloomberg Intelligence. I don't have any sales or consulting advisory responsibility anymore, which is great. I don't have to go around selling stuff. I just have to write good stuff and get it noticed on the team. We've got a team of 5.5 professionals writing market structure research across US and European equities, as well as fixed income and swaps market. So we have a broad swath. We can be found on the terminal at BI space MKTS. We have research. We've got a lot of great data too. Prior to that, I was head of research and consulting for Tabb Group, which I had founded. I had sold in 2016. And prior to that, I wrote fintech research before fintech was fintech. Basically, I started in 1996 at Tower Group, and before that, I ran business analysis for Lehman Brothers. I built a lot of systems back in the early or mid to late 80s and early 90s. And before that, I ran various operations at Citigroup and the investment bank from 80 to 86. And I've, part of the SEC Fixed Income Market Structure Advisory Committee, been on the CFTC TAC committee for many years, really, whatever. So I'll talk a little bit about, also want to thank Main Finance, or Frankfurt Main Finance. Bloomberg is an active member of this organization, and we're very proud to be part of it. And anything we can do to help you guys, we're happy to. So, with that, I'll talk a little bit about what is short selling, some of the controversy. Is this real? Look at some of the fails data, some of the academic research, some of the regulatory issue, and come up with some conclusions. So what is short selling? Well, we know what traditional investing is. You've got a stock, you buy it at a low price, you sell it at a higher price, and you pocket hopefully some change once you sell it. You've got Apple in this chart. You buy it at 144 and change, you sell it at 151 and change, you make about $6 per share in this trade. Everybody is comfortable with this. This funds companies, and it's the premise behind investing. Short sellers look at the market the opposite direction. They think, well, you know what, this 151 may be a bit too high. So maybe we're not comfortable with the price of the stock this high. Maybe we've done a lot of research and believe that sales for Apple this quarter aren't going to be as good. Maybe there's some sort of scandal that's brewing. Maybe some other reason that you believe that you're not very happy with the price of an asset where it is. And so what you do, opposite to the traditional buy then sell, is that you sell and then you buy. And what you're looking to try to then do is pocket the difference. So in this case, we saw Apple run up from 145 basically to 151, and it then retraced its path basically from a high of around 151 back to 145. So we sell it at 151, we buy it back at 145, we pocket another $6. So instead of making $6 and being out of the market, we've made $12, and we've risen, we've gone up, we've taken the stock on the upside and then taken the stock on the downside as well. So short sellers, because you're selling before you're buying, of course, you believe that the asset prices are too high and they're going to fall. Traditionally, as I said, investors use cash to buy assets and liquidate. Short sellers believe that they're going to do the opposite, that they believe this stock price is too high, or this bond price is too high, or the swaps price isn't right. So we're going to sell before we buy. The big challenge here, and conceivably, if there were no issues around delivery, or if there are no issues forcing you to cover the short or margin, you could sell, and then when you sell, you generate revenue. You could take this cash and hold it in your pocket and do whatever you want with it. The problem is that eventually you have to actually deliver these securities that you've sold. So while you can sell short, you can't deliver shares you don't own. So that forces you to borrow them. There are also some rules around the world, especially in the US, around how you need to manage shorted securities. In the US, the U.S. forces you to get a locate from your broker. And then what that is basically that your broker needs to be able to put their hands on those securities so that if when it comes to actually delivering these securities, they actually have them and you don't fail. Borrowing is actually the cost of shorting. Again, as I said, while you can sell short on trade date, when it comes to settlement date, you can't deliver securities you don't own. And borrowing can be difficult and expensive. If you're borrowing something that's pretty easy to borrow, then it's not very expensive. You're basically paying a financing charge. However, if a lot of people believe that this company needs to be shorted, or the stock is too high, or the asset price is too high, it can be a bond, and everybody is short, then everybody's trying to borrow, and there may not be that much of a supply of stocks or bonds to borrow. And it can get very expensive, and you can get into rates of over 100%, per year that you're paying in financing charges. So the other issue is when you're short or when you're long, all you can really lose is, the price of your investment. You buy Apple at 151. If it goes to zero, you've lost your $151 per share. On the other side, if you're short, well, let's go back to the long position. That said, if Apple goes to $100,000, you've made virtually an unlimited amount of money, or put it this way, a very healthy return if you bought at 151. So when you on a traditional trade, your downside is capped to your investment. Your upside can be unlimited. The challenge with short selling is your upside is capped. If you sell at 151 and it goes to zero, you've pocketed $151. On the risk side, if Apple goes to $100,000, then you've sold it at 151. You've got to buy it back at 100,000. That's going to be pretty challenging and pretty expensive. So a lot of these transactions are done on margining. You generally need a margin account. There are generally rules in terms of the value of the assets, the amount that you've borrowed. In the US, it's 50% initial margin, goes down to 25% later. If you wind up crossing that 25% threshold, the brokers can basically sell out your position and force to close out your position. And as I said, your borrowing can be very expensive, especially if it's a hard to borrow instrument. Now, the big controversy around shorting has tended to be around what they call naked shorting, which is you sell it, you don't borrow it, and then you what happens is you fail. You haven't borrowed it, you sold it short, and theoretically, this basically gives you an unconstrained amount of securities to sell, which can then kind of somewhat pummel a stock or a bond into the ground. That said, in the U.S., that's pretty regulated, and then you have challenges where it's not regulated. So locates are actually kind of interesting. Theoretically, what happens? Sorry about this, my eye is itching. Locates are kind of interesting. What a locate is before you sell short, you've got to talk to your broker or electronically talk to your broker and basically say, hey, look, I'm going to short this instrument. Can you find it? Do you have a locate? Can you get access to these securities so that in 2 days you can cover it? Many times the locate is provided by the broker. The investor, however, can find that those securities from other brokers or other custodians. Generally, what happens is The custodians for large asset managers, as well as retail brokerage players, are the places to go to find securities. Custodians, of course, are holding the assets of the big mutual funds and big asset managers, folks like State Street or Bank of New York in the U.S. or Citi and other large custodians have tremendous quantities of securities that they are holding for third-party asset managers. That's a good place to go, as well as retail brokers where they have individual mom and pop folks that have bought shares and they're just sitting at the broker. That said, the broker will tend to leverage those in their prime brokerage first before they lend them out, but there are securities that are there. Now the locate is just the broker's view that they would be able to cover that, and they kind of know where to go. That said, that locate can be used multiple times. So two customers come to me. I've got 100 shares, both want to short 100. I can use that locate for both of my clients, supporting 200 shares being shorted, whereas I only have 100 shares. The issue there, though, is that the broker needs to have a reasonable view that one of those shorts will be covered by the time they actually have to settle, and they will only need to deliver 100 shares. So they can use those locates multiple times, but by the end of the day, they really need to have all their securities covered. Also, officially registered market makers in the U.S. are exempt from obtaining locates, but most dealers go home flat. So the issue there is that if you're a market maker and you're constantly buying and selling, a lot of times you're selling before you buy to cover, but you're going to cover because you really don't want to take large positions or large risks that go on for a long period of time. The controversy here is that selling before buying means that there are a lot more shares outstanding than issued. So you've got firm A, they float 1,000 shares. Investor Z buys all those 1,000 shares. Investor S wants to short 500 shares of firm A, but needs to borrow them. Only investor Z has them, so Z lends S 500 shares. He collects a fee, so he gets a little bit better return on his 1,000 shares. And then investor S sells those 500 shares to investor L for long. But now Z owns 1,000 shares. Actually, A owns 1,000 shares. I got that. No, investor Z owns 1,000 shares. I did have that right. And investor L is long 500 shares as well. So even though investor short is 500 shares, the float now equals 1,500. There are 1,500 shares where they're long in firm A, even though they only floated 1,000 shares. So what this theoretically does is it provides more shares out in the market. It can depress the price of a stock, given the stock prices to do with supply and demand. So there's more supply out there, so demand would be lower. And that then plays into the idea of short selling. So, and if you talk to a lot of the Bitcoin folks, they're very adverse to this process because they want the price to go up and not down. You've got some challenges. The short selling magnifies the float, as I said, to be more than actual shares issued. You can even have short positions where you're more than 100% short of the stock. So more than 100% of the shares outstanding are actually short. That doesn't necessarily mean that there are no borrows and everybody's failing, even though probably may mean that the number of fails are higher than normal. But a borrow could be borrowed multiple times. So I lend my 500 shares out to somebody else. They sell it. Someone else buys it. The person who buys it lends it out again. Somebody else shorts it. That person who bought it lends it out. And so you can see that the same securities can be shorted a number of times, giving our electronic framework of how we manage security settlements and how we manage shares. And as these securities become harder to borrow, the more shorts they are, the borrow rates rise and gives them even more incentive to lend. And the original investor, all they know is that they bought 100 shares. They don't necessarily know that they bought them from someone who is short. They don't really know who actually owned them, whether they, whether they're original shares, whether they're shorted shares. This whole issue revolves around a couple of things. One is margin. What's going on with the price? Is it going up? Am I being asked to put up more margin? What do I have to, what does it cost to borrow? And again, what's happening with the stock? Naked shorting can theoretically push a company into bankruptcy. Naked shorting occurs when the investor doesn't borrow shares. There are a lot of fails. This used to happen before the SEC put more teeth into Reg Show. That was over 15 years ago. It's thought that investors are forced to cover their borrowings. Investors theoretically sell, if they didn't have to cover their borrowings, investors could theoretically sell the stock to zero and bankrupt the company. There's not a ton of evidence that this happens a lot. But there's a lot of political issues around it, and certainly the CEOs and everybody all the holders of the stocks and all the people within the company don't want to see their stocks go down to zero, and this creates a lot of challenge during market turmoil. We saw this in 2008, and we've seen this in other turmoils where jurisdictions put in short selling bans to try to stop this pressure. That said, most of the academic research, we'll talk about that in a minute, basically say that that's not a good thing. And I'll talk about why in a couple of seconds. I talked a little bit about Reg Show. That's the rules around short coverings and shorting, forcing investors to put in locates. In roughly November 2008, the SEC really put a lot more teeth into the Reg Show rules, and you can see that the level of fails dropped. And that's even given the notional traded has increased tremendously. You're seeing the average daily number of fails in terms of value failed is really 0.5% per day. And while that isn't great, we would love to see that number lower. It's actually pretty efficient given you're trading 600 billion in shares a day, and only 0.5% fails. That said, there are other reasons for failing. There could be price differences. There could be, a trade, I don't know a trade. There are a lot of reasons for failing besides just not being able to cover. However, these stats don't necessarily include options and swaps. However, options and swaps generally need to be hedged in the cash market. So those risks kind of go back to the hedged market. And those fails only measure dealer to dealer through the clearinghouse. It doesn't really measure how many shares that dealer A is failing to buy side B, or buy side C is failing to dealer D. So those don't necessarily show up. So the stats are probably a little bit worse than they look. That said, it doesn't seem to be as big a problem as it was, in the early aughts. Short squeezes can force sellers to buy. This is a very interesting thing that goes on, is that if a security gets oversold and there are too many shorts out there, generally hedge funds or generally folks could have been dealers, can just, try to, buy and buy and buy and push up the price of those stocks. And then what that does, or it could be bonds, or it could be currencies or whatever, but currencies are kind of hard to do that, you need a lot of cash. The issue there is that you need a fairly large bankroll, and if you start getting that stock higher, you wind up putting greater pressure on the short sellers, and eventually they've got to give up and cover their short positions, which then push the stock even higher. This is called a short squeeze, and it happened to AMC and GameStop and a few other meme stocks, where you've got a stock that was trading, for GameStop was trading in below 20, and then was all, was pushed up to, $450 a share. And so, and traditionally, as I said, this is done more with hedge funds, but this happened through Wall Street Bets, basically a Reddit bulletin board, where all these retail investors flocked together. They all coordinated. They all bought AMC and GameStop and these meme stocks, and have kept the price of these stocks way over their theoretic intrinsic values for a very long time. This meme stock issue happened in January of this year. These stocks are still way over what anybody would consider a reasonable value. And it doesn't look like the SEC has the power or is going to do anything. But that said, the SEC GameStop report is coming out in the next couple of weeks. It'll be interesting to see what they recommend. Is banning short selling a good thing? Most academics don't think so. Short sellers generally provide a service. First, they're looking at companies and analyzing their financials and making sure that they're not doing anything flaky. And if they are, they're short selling. And we've seen a number of occasions where short sellers have unearthed accounting problems or challenges or issues that are really, very legitimate. And they've been able to profit off this. Generally, short sellers, while they may not necessarily have the tools and services of a regulator, there are a lot more short sellers and a lot more investors out there than there are regulators. So they can uncover a lot of things that the regulators can't. The other benefit to short sellers is they provide liquidity. So, and this gets back to short selling bans. A lot of investors are long short investors, so they look at relative value of a pool of stocks, say the S&P 500. They go long, they go extra long. The ones they really believe in, and they take the bottom portion and they short, and they use that short, they use the cash that they generate from being short to fund those extra sales of the ones that they really believe in. And the problem is, if you ban the short sales, then what happens is these folks don't necessarily have the cash, they can't go long. And so you wind up crowding out a lot of liquidity. And in a time of financial stress, liquidity is really, kind of what you need. And from a regulatory standpoint, they can highlight fraud and issue and challenges in the marketplace. So what should regulators do? Try to withstand the political pressure to ban short selling, especially during crises. That happens all the time. And I've been an analyst in this market for 25, 26 years. I've gone through a number of crises. And before the financial crisis, you typically hear the banks say, poo-poo, don't ban short sellers. We like short sellers. They provide liquidity. And of course, when the short sellers were selling the bank stocks in in 2008, what was the first thing they did? They ran up to Capitol Hill and said, you should ban short selling. The question is, what's good for the goose? It must be good for the gander. So that said, the regulators should probably try to withstand the political pressure to ban short selling, especially during crises. I think, look at trying to implement tight rules against naked shorting, push reg show type, but even possibly tighter where you don't have as loosey-goosey an environment where I can't use locates multiple times, where I have to cover these shorts in a quicker time implement. Think about reporting delays. Do you want to report these shorts quicker? That will put increased pressure on the short sellers. Possibly close more loopholes with options and single stock futures, maybe higher margin on swaps. Fail reporting. By providing fail reporting and even wider fail reporting, maybe not just dealer to dealer, but dealer to buy side as well, you get a better understanding of, is this a real challenge? And certainly tightening the settlement cycle will hopefully automate this process more and make it more streamlined and close some of the gaps. Currently, of course, we're in a T2 trade day plus 2 day settlement cycle. The DTCC just came out with a test pilot to move to blockchain. Or actually, their pilot came out. It was successful. They're going to put it into a project form. They're going to look to try to get that live first quarter of next year. It'll be really interesting, but it's not the whole market. It's only selected portions of the market who are going to net out on a same day basis. But it's interesting. We're starting to see a move towards T1 and T0. So that should help this a bit. Conclusions, and then I'll take some questions. Certainly short selling is controversial. The public generally believes it's anti-investing, is that folks need to provide money to capital or capital to companies. They don't think that you should sell before you buy. However, short selling provides market liquidity. It reduces volatility. It highlights and rewards investors for digging into problematic companies. However, I wouldn't say that everything is wonderful in reporting land and in investing land. I think better reporting would be much better. Tighten some of the gaps, better issues around reg show or how you provide locates or the process around shorting. Loopholes around derivatives and how these are tied into the cash markets. Tighten borrow locate loopholes, and think about a shortened settlement cycle, which put more pressure and hopefully force folks to streamline this process. And automation would certainly make the market better and more efficient. And with that, I will take some questions and stop my share.
Excellent. Thank you, Larry, very much. And the first question which we have coming in refers to meme stocks. You mentioned GameStop and other meme stocks. Is it popular to short meme stocks, or is it just playing with fire?
I think I've looked into some of the meme stocks and their short interest. And while initially I would say early January of this year, they were heavily shorted. There are very few people shorting them these days. That said, there's a lot of things going on in the options market, but these are not hard to borrow anymore. Because the challenge is, who knows when these guys come back into the market and basically blow you up.
So has that changed market dynamics? Has that changed market structure?
It really hasn't. These stocks are still way overvalued. In fact, you've got GameStop, I forget where it's trading today, but it's over 150. I think it's around $150 a share. This is a retail stock with a retail video game store that basically sells video games that you can buy online on the internet. The business model, it's kind of like a video cassette cartridge rental like Blockbuster. The question is it worth $150 a share? I'm not so sure.
So you
and AMC and you've got movie theaters in a pandemic. I'm not sure that they're very crowded these days. So, but then again, I'm not an investor, so don't take your investor advice from me. But it seems like these stocks are way overvalued, and the short sellers are not in there, mostly because these armies of retail traders are just bidding them up, and not, in no rational way.
But you more or less said you don't expect much of remedies coming out from the SEC and the report that's coming ahead in the next couple of days.
I think maybe there may be some better reporting that comes out of this. I don't think they're going to go sue individual investors for coordinating on these message boards. But maybe they will. I don't know. I haven't seen the report. But it doesn't seem like you've seen, the SEC doesn't seem to be hauling these guys in for questioning, or at least, I haven't heard media to that issue. So I'm not sure there's going to be a ton. Maybe there'll be better stuff on short selling disclosures. Maybe they'll tighten up Reg Show a little bit. But I'm not sure they're going to individually go after these mom and pop guys who are buying GameStop or AMC.
So what do you see, Larry, when short selling is prohibited? What are the typical strategies to circumvent such prohibitions?
Well, the challenge, that you wind up in the derivatives market, but the problem is that the person on the other side of that trade then needs to cover it, and then what do they do? And so the question then is who is prohibited from selling? Is it short selling? Are they investors, or do they still allow market makers to short sell? It depends on how wide the band goes. Generally, market makers are usually exempt from these things, but it really depends. And if the market maker can short, then they can create a derivative that an option or a CFD or something like that to get around this ban.
Mm-hmm. So what we've seen in the past is that short sellers bring new information, or at least a new way to look at certain informations, and bring light into some darker corners of the company or the market. How do retail investors tell if the information is true, or just serve the purpose of some short seller attacks, which they intentionally give out false? So
we've seen a lot of that. We've seen a lot of that. If you go back 10 or so years, Overstock.com was a frequent complainer about short selling, and there was a lot of short interest in that. You've seen the issues with Herbalife and the big, the big hedge funds on both sides of this, saying, one's right, one's wrong. One says the Ponzi scheme, and sometimes it's really hard to figure out. I think it's easier if it's just an accounting irregularity, and you can kind of find the issues in the numbers. But some of these reach into much bigger issues, and it's hard for investors to figure this out.
You also mentioned you can not only short stocks, but you also short, for example, bonds. And the next question is, to what extent is shorting interacting with the CDS markets on bonds?
Oh, I think there's a fair degree of, the CDS market was really created to short corporate bonds, and so that that was a pretty significant issue in the financial crisis. That said, I haven't followed some of the remedies there, so I don't know what's going on with the regulators in the CDS market. That said, the CDS market post-crisis really is down a tremendous amount. There's a lot less volume in the overall CDS market, period. I guess they went into central clearing, the swaps. They needed to put up margin. I guess, but well, both of those issues really took the wind out of that market sale. So there are things that the regulators can do even outside of the stock market.
So next question is, what do you think the SEC will come up with rules regarding activist short sellers? Do you expect them to come up with a rule like publish first before you short?
I don't know. I don't know. The activist investor issue is a big deal. Certainly the corporations don't want to have activists on their board or buy big blocks of their stock. I have not followed that issue as much, so I'm not sure what the SEC is going to do there.
You were saying in the beginning of your presentation, Larry, that you eventually can have even more than 100% sold short. That sounds a bit counterintuitive. Is that in a market of highly regulated naked shorted also possible? And if yes, how?
Yeah, absolutely. So if you think about it, I buy 1,000 shares of stock. I lend it to you because you want to sell it. You sell it to someone else. Somebody else wants to short it. They get the stock from either you or the person you sold it to, and you can wind up, as long as the people who own the stock have it in a place where it's liquid, which means either a margin account at a brokerage firm. Or an institutional investor that custodies at one of the large custodians, and they have a lending agreement. The custodian can just lend them out, and the client winds up getting a couple of basis points in return for lending them out on a daily basis. And those stocks can be reshorted, and they can be shorted and shorted as long as they're in a place that is electronically accessible and a lender can grab them. They can be lent. Now, individual investors generally don't get any of that benefit. They don't generally get any return on those stocks so the 1,000 shares I bought in my XYZ broker account, if they're in a margin account, my broker can just take them from me. It looks like they're in my account. They all seem to be there, but in reality, if you look at the stock record, they're gone. They've been lent to someone else who shorted it. So, yeah, you can very conceivably be in a highly regulated market, as long as everybody agrees and as long as custodians are electronic, have the stock electronically accessible. Those stocks can be shorted multiple times.
Mm-hmm. Okay, so while I make the call for the last round of questions, Larry, in terms of short squeeze, is that precisely defined when you talk about a squeeze? How heavy need the movements be, or what kind of actions do you need to see in the market before you speak of a short squeeze?
That's a good question. It's just people buying up the assets of something that folks are shorting, and the price starts to move in the opposite direction. This doesn't happen just in stocks. Back in the early 80s, I was working at Citibank in the fixed income side. I was supporting operations for the front office of the dealer, the Citibank dealer, and we're coming to the end of the year. It was a December refunding, so it was around December 15th. Citi had already pocketed pretty much a lot of its profitability. They weren't taking anything. They weren't, making too many aggressive bets. And somebody, basically, a large dealer who I will not name, basically gobbled up all the bonds, and the dealers wound up short, and it wound up costing Citi millions of dollars to find those bonds to cover all the sales that they had out to their clients. So this doesn't necessarily happen just in stocks. And if you go back to the Salomon Brothers Treasury bill scandal or Treasury note scandal in, and I forget, the early 2000s, maybe 1990s. I guess it was the 90s, the early 90s. That's what this was all about. They basically, took down the whole auction and short squeezed the 2 and the 5-year notes. And I think it was a 10-year note. So it's not just stocks. The regulators put in a lot more rules since then. But this isn't necessarily just a stock phenomenon.
So you rightly mentioned, and that's my last question for the day, Larry. You rightly mentioned that the image of short sellers isn't that good.
It's not very positive.
It's not very positive. No. So can you give us a story or two where you see, in that instance, short sellers have done a market to create services? Was it the Enron case? Was it the Wirecard case? Or where would you say?
Absolutely. You've got both of those cases. You've got even Lehman, and I was an old Lehman guy. Not that I was there at the end. But you've got these people digging around, trying to make sure that these companies are solvent, or make sure that there's not fraud going on. Take a look at Theranos. There are a lot of these issues where you've got these companies that are not what they say they are, and you've got smart people digging around. You've got Madoff, even though they weren't public. You've got these people that are digging around trying to say, this just doesn't seem. It seems too good to be true, and short selling gives those people the incentive to bring these issues to light and bring them to the regulator and bring them to the public. And while I'm not saying that these guys are the best things since sliced bread and they're wonderful and I would like to go out to dinner with them, they do provide a service, and because you don't want these frauds being perpetrated forever.
Excellent. Thank you, Larry. Now we know that you're not going to have a dinner with, but nevertheless defend the case of liquidity and positive structure in the market. It's been a delight to have you, Larry, at that very early hour in Massachusetts. We know in your back there was a thunderstorm, and we're pretty happy that all the connections were very stable.
Yeah. Sun's starting to come out. It looks like it's stopping the raining, so it's good.
Yeah. Excellent. So we'll wish you it's going to stop raining. The sun is going to come out again, and you have a great day, a good start in the day. We'll say thank you, ladies and gentlemen. Today's event draws to a close. Thanks for coming, and looking forward to see you next time. All of you, a very nice day. Thank you, Larry.
Thanks.